Did you know that 85% of beginner traders fail within their first year, and the number one reason isn't what you think? It's not risk management, it's not psychology, it's not even lack of capital. It's timeframe confusion. Today, I'm going to show you the complete system that professional traders use to eliminate timeframe chaos forever. Picture this, you're looking at a 5-minute chart, and you see a perfect bullish setup. You're about to buy, but then you check the 1-hour chart, and it's screaming sell. Confused, you jump to the daily chart, which shows neutral. So you check the 15-minute chart for a tiebreaker, and now you're completely paralyzed. Sound familiar? This random hopping between time frames is destroying your trading account, and here's why. The average beginner trader has 6 to 12 different time frames open simultaneously. They're checking everything from 1-minute scalping charts to monthly position trading charts, trying to find the perfect entry. This information overload leads to analysis paralysis, where you spend hours analyzing but never actually trade. Or worse, you enter trades at the worst possible moments because you're getting conflicting signals from different time frames. If you're working a day job, you've probably experienced this. You do all your analysis on the weekend using daily charts, but during the week, you can only check your phone for a few minutes. So you start using 5-minute charts for quick decisions, completely ignoring your original daily chart analysis. This disconnect between your analysis timeframe and your execution timeframe is costing you money. Let me show you 3 real examples. Trader A bought Tesla because the 15-minute chart looked bullish, ignoring the daily chart's bearish trend. Result, minus $2,000 loss. Trader B sold Apple because the hourly chart was overbought, missing the daily chart's strong uptrend. Result, missed plus $3,500 profit. Trader C spent 4 hours analyzing 8 different time frames and never placed a single trade. Result, opportunity cost of the entire trading day. Here's the first rule that will transform your trading: you only need 3 time frames. Primary, secondary, and confirmation. That's it. Professional traders don't use 10 time frames, they use 3 strategically chosen ones. Your primary time frame is where you make your trading decisions. Your secondary time frame provides context and direction. Your confirmation time frame fine-tunes your entry and exit points. Your primary time frame depends entirely on your trading style and available time. If you're a scalper making 20+ trades per day, your primary time frame is 5 minutes, secondary is 15 minutes, and confirmation is 1 minute. If you're a day trader making 3 to 5 trades per day, primary is 15 minutes, secondary is 1 hour, confirmation is 5 minutes. If you're a swing trader holding for days or weeks, primary is daily, secondary is weekly, confirmation is 4 hour. Position traders use weekly primary, monthly secondary, and daily confirmation. Here's something most educators won't tell you: your account size should influence your timeframe choice. With a $1,000 account, you need higher frequency trades to grow meaningfully, so shorter time frames like 5 and 15 minutes make sense. With a $10,000 account, you can afford to wait for higher quality setups on longer time frames like hourly and daily. This isn't just about patience, it's about mathematics. Smaller accounts need more opportunities, larger accounts need better risk-to-reward ratios. Let me show you exactly how this works in practice. Day trader setup: primary 15-minute chart shows a breakout above resistance. Secondary 1-hour chart confirms we're in an uptrend. Confirmation 5-minute chart shows a pullback entry opportunity. Entry made. Swing trader setup: primary daily chart shows a reversal pattern. Secondary weekly chart confirms oversold conditions. Confirmation 4-hour chart shows momentum divergence. Entry planned for next day's open. Position trader setup: primary weekly chart shows long-term trend continuation. Secondary monthly chart confirms multi-year support level. Confirmation daily chart shows accumulation pattern. Position built over several days. Here's the reality: time frames will conflict. That's normal and expected. The key is having a systematic approach to resolve these conflicts. When your primary timeframe says buy but your secondary says sell, you don't freeze up. You follow the hierarchy. The longer timeframe always wins in conflicts. If your daily chart is bearish and your 15-minute chart is bullish, the daily chart takes priority. This is because longer timeframes represent more significant market sentiment and have greater predictive power. Here's your conflict resolution hierarchy. First, check if the conflict is major or minor. A major conflict is when primary and secondary timeframes completely disagree on direction. A minor conflict is when they agree on direction but disagree on timing. For major conflicts, always side with the longer timeframe and wait. For minor conflicts, use your confirmation timeframe as the tiebreaker. If all three timeframes disagree, that's a clear signal to stay out of the market entirely. No trade is better than a confused trade. Real example 1, Apple daily chart shows strong uptrend, but 1-hour chart shows potential reversal. Solution: wait for 1-hour chart to align with daily trend before entering. Real example 2, Tesla 15-minute chart shows bullish breakout, but 1-hour chart is in strong downtrend. Solution: skip the trade entirely, as this violates the hierarchy rule. Real example 3, SPY weekly chart is bullish, daily chart is neutral, 4-hour chart is bearish. Solution: wait for daily chart to show clear bullish bias before considering long positions. Here's your decision matrix: act when all three timeframes align. Wait when major conflicts exist. Skip when complete disagreement occurs. This simple framework eliminates 90% of timeframe confusion and prevents you from making emotional, conflicted trades. If you work a traditional 9-to-5 job, you have 3 optimal trading windows. Pre-market from 7 to 9 a.m. Eastern allows you to trade before work using overnight developments. The lunch break window from 12 to 1 p.m. Eastern offers lower volatility setups. After hours from 4 to 8 p.m. Eastern provides earnings plays and news reactions. The key is choosing one window and mastering it, rather than trying to trade randomly throughout the day when you can steal moments from work. Pre-market strategy: focus on earnings gappers and news-driven moves. Use daily charts for context, 15-minute charts for entries. After-hours strategy: trade earnings reactions and guidance updates. Use weekly charts for context, 30-minute charts for entries. The critical point: your timeframe strategy changes with the session. Pre-market is more volatile, so you need shorter confirmation timeframes. After hours has lower volume, so you need longer confirmation timeframes to avoid false signals. Weekends are when part-time traders do their heavy lifting. Scan weekly charts for major trends. Identify daily chart setups for the coming week. Create watch lists with specific entry and exit levels. Set alerts for your target prices. This preparation allows you to execute quickly during the week without getting caught up in timeframe confusion. Your weekend analysis uses longer timeframes, your weekday execution uses shorter confirmation timeframes. Swing trading is the perfect solution for busy professionals. Primary timeframe: daily charts for trend identification. Secondary timeframe: weekly charts for major context. Confirmation timeframe: 4-hour charts for precise entries. With swing trading, you can do all your analysis after market hours and execute orders the next morning. You're not fighting against your schedule, you're working with it. Here's how to set up your trading platform correctly. Create 3 chart layouts: Layout 1 for scalping, 1 minute, 5 minute, 15 minute. Layout 2 for day trading, 5 minute, 15 minute, 1 hour. Layout 3 for swing trading, 1 hour, daily, weekly. Never have more than 3 timeframes visible at once. Use the same indicators on all 3 charts for consistency. Set up alerts on your primary timeframe only. This prevents indicator overload and timeframe confusion. Most platforms allow you to sync your timeframes. Enable this feature so that when you click on a candle in your primary timeframe, it automatically highlights the corresponding period in your secondary and confirmation timeframes. Set up hotkeys for switching between your 3 timeframes quickly. Configure your workspace so that the primary timeframe is largest and centered, with secondary and confirmation timeframes in smaller windows. Your mobile setup should mirror your desktop hierarchy. Set up 3 charts: primary, secondary, and confirmation. Use simplified indicators that display clearly on small screens. Set price alerts based on your primary timeframe analysis. Enable push notifications for your alerts only, not for every minor price movement. This keeps you informed without becoming a distraction during your workday. Here's your step-by-step implementation plan. Step 1. Determine your trading style and available time. Step 2. Choose your 3 time frames using the guidelines I provided. Step 3. Set up your platform with the correct layouts. Step 4. Practice with paper trading for 2 weeks using only your 3 time frames. Step 5. Create written rules for conflict resolution. Step 6. Set up mobile alerts and monitoring. Step 7. Start live trading with position sizes that won't cause emotional stress. Remember, discipline beats complexity every single time. Let's recap what we've covered. The 3 timeframe rule eliminates confusion. The hierarchy system resolves conflicts. The trading style matrix determines your optimal timeframes. The part-time trader solutions work with your schedule, not against it. And the implementation checklist gives you a clear path forward. Here's what you need to do right now. First, comment below with your current trading style and available time, and I'll help you choose your optimal 3 time frames. Second, implement this system with paper trading before risking real money. Third, subscribe for more advanced timeframe strategies, including how to scale this system as your account grows and how to adapt it for different market conditions. Remember, every professional trader started exactly where you are now. The difference is they learned to master timeframes instead of being mastered by them. Stop hopping between charts randomly, and start trading with the systematic approach that actually works.